Hi guys, welcome back. My name's Aaron. This is Czar Finance episode 41, Technical Analysis and Moving Averages. Alright, so when it comes to a moving average, it's basically an average price of the security over a set amount of time. So as you can see in this S&P 500 example here, you have a bunch of different candlestick charts that are providing you data on a weekly basis, which I have up in the top left corner here. And what it does is it basically takes the average of them and it plots a general line on them. You can turn these on, turn them off, change it to different colors, etc. And the simplest form of a moving average is basically known as the SMA, the simple moving average. And it's calculated by taking approximately 10 days in the past and it plots a point on there. So it'll take 10 days. So if you just randomly choose 10 digits, for example, add them up and divide by 10, you'll get a sum of the numbers and it'll plot a point on there for you. But the reason why it moves is called it's a moving average. So what will happen the next day, you'll get a new set of data when the market closes and it'll move forward. So it's like a trailing stop. Every 10 days, it always is attached to the forward moving one. So it'll be like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then the next day will be down here where it'll show another port, and then this one will be left behind. So it's always on the leading front of the stock symbol itself. Now there's different types of moving averages that are out there. Typically speaking, they come in different common time periods. They have an 8 EMA, which is basically an exponential moving average. So again, I told you before, there's one SMA, simple moving average, which is 10. And then they have exponential, which is a moving average, is a type of moving average that gives more weight to recent prices in an attempt to make it more responsive to information. So it's a little bit more volatile, and you can change the different type of days that you want. If you want a 2-day, a 3-day, a 5-day, a 10-day, a 100-day, whatever. And typically speaking, the common time periods that most people view is an 8-day, a 20-day, a 50-day, a 100-day and a 200-day moving average, give or take, customizations to people's likings. Now, in order to get these customizations here using TradingView, the best way that I find is you just right-click anywhere here, and you're going to go to, where does it say, Insert Indicator. When you hit Insert Indicator, it will pop up a screen here, and then you can type in a search for moving average exponential. And when you click on that, it'll add an extra one in there for you. And when you click on this, let's see, if I go to the gear, you can set the line thickness for this. You can set the inputs. Do I want a 300-day moving average? And I don't know. And you'll see the colors right here. See this? I can change the colors. I can give this, I don't know, let's give it green. And I can change the line types with breaks. I can say a histogram. I can say all sorts of different types of things, crosshairs, whatever. But for right now, the default is pretty good, and I like to keep it a certain pattern, keep it a little bit lightweight, and just use that here. So as you can see, this here is a 300-day moving average, so it's going to count 300 days. Okay, these are in weeks right now, so it's going to count 300 days within those weeks, and it's going to give you the average. Notice that it's spread apart, quite far apart from one another. The smaller ones are a lot closer because they're a lot more tighter on the day of the moving average, whereas these are a little bit further apart. Now, when it comes to moving averages, you can look at them and see the time span, and start to generalize certain trends off of this sort of type of thing. Right now I'm going to delete this because I don't need this one. I'm going to remove this one, And what you can do is look for trends. You can see if there's an uptrend or a downtrend. Looking at the S&P 500, you can see these waves right now. Okay, they're going up. Or at least in the past they were going up, but now it's almost starting to crest. Are we going to stay within this trend line pattern or in this trough area, or are we going to bounce off of them? Are we getting a lot of momentum upwards? You can look at the moving average and see if there's a lot of momentum. There's a large gaps. There's a lot of people buying in certain things, causing a big momentum here. But if you look closely over here in this area, you'll start to see that the trend lines are starting to cross. Let me just kind of zoom in here for you and just kind of show you as best I can. You'll see here this line right here. This is the 20 moving average. It has crossed over the 50 moving average. So there's a crossover, and also with this red one, the 8 EMA has crossed over. So there's a dip right here. So you can see how there's a cross and then another double cross, and this is causing the lines to get congested in between here, which causes different. I don't, you can say support and resistance lines, if you will, but it causes different types of things to happen in the market. Now, you typically want to stay above the 200 moving average, which is down here, but sometimes if the market starts to go down and down and down after 200 days, it could bounce off that. Now, you can use these lines as support and resistance, as indicated here. If I zoom into this really quickly, you can see how this support line right here, which one is the green one? The green one is the 20-day moving average. The 20 moving average, it has bounced down through here and bounced back up. It bounced off of it, then now it's riding the 8 EMA, so it's riding above the line. So that's, you can ride this as support, which is supporting it, and then it acts as resistance that can resist underneath it. If the trend or the stock starts to fall over it, underneath it could be marked as resistance. So that's another way of looking at trend lines, as a support line and as resistance. It can bounce off them or on them. There's different types of stop losses on them. There's a crossover. Basically, a crossover is where the stock has crossed over from down below, if you will, here to up above. So it's crossed over the line. So it was below the 8 EMA, okay? And now it's above the 8 EMA. That's called a crossover. So sometimes when stocks jump below here and then it jumps above, it's called a crossover. And sometimes people like to look at that and sort of say, okay, now we're in market reversal here. We've crossed over the line, so now this is going to act as support, bouncing on top of the line. Versus, oh, now we're underneath the line, which is now we're going to be below it or whatever. You can have a thing called a moving average envelope, which basically sometimes people like to see the stocks that are right here. This is on the weekly average for the S&P 500, that they will fall in between an 8 EMA and the 20 moving average, or the 8 EMA and the 50 moving average, so that the stocks will bounce in between there, which is called an envelope. It's basically the same thing that I kind of have here with these two trend lines right here, that as long as it's within this range, it's gonna, you can kind of predict where it might be going. So you can look at the signal and trigger lines, are also called a MACD, which is a moving average convergence divergence, which we're going to get into next week or the week after, and talk about the MACD, which is a great indicator for which direction you think the stock is going to go, whether it's up or down. I have it listed down below here, and I have it actually turned off because I don't have it showing right now. But this is a brief introduction of the MACD. Again, it's called a moving average convergence divergence, where these two lines converge or diverge from one another, and you can tell by when they kind of reverse, or if they're going to go down below the zero mark over here, and sort of give you another hint towards what might be a great way to predict where the stock market might be going for a particular stock. You can look at those and you can start predicting when to buy, when to sell, when to get in, when to get out. So basically, moving averages is just the sum of them. It's moving them, it's gathering the days that you have, adding them up, getting the sum of them, finding out where the stock falls, and looking at the lines and sort of taking a look at where things are falling in the stock market. So if you look at, say, GoPro, GPRO, you can see the different moving averages that are listed, here. So it's sort of going down right now for GoPro, but I also have it kind of slingshotting up because we're at the bottom of the trough here. You can see that's kind of coming down, and it's going to kind of slowly roll up. Possibly, we don't know for sure, but right now it's in this channel, in an upward channel, and it's coming down, and it's going to possibly sling up like this and go up in this direction, because the general form of the moving averages are down here. And you can see as time has gone through here, the stocks have crossed over, and now they're riding, and these support lines are acting as, these moving averages are acting as support lines for the stock to typically rise up. It might bounce off this resistance line here, which is the 100-day moving average, as this gets through here, and act as a resistance line to kind of get through, but we'll see. That's an example of GoPro. There's so many different types that are out there, but the main thing I wanted to talk to you guys was moving averages, and getting you to understand that there's lots of different ones, lots of different philosophies on the moving averages. You can choose any different type you want. Some people like to use certain types, certain days, certain ones that look better than others. I'd say keep it small. Don't get too carried away. You do not need to have all these types of moving averages up on your screen. I usually typically have 2 or 3 that are on there just to kind of give me a little foreshadowing of maybe what might be going on and see whether this line is, the moving average is going to cross over or whether the stock's going to bounce off of it or not. So take a look at that the next time you look at a stock symbol and turn your moving averages on. I'm using TradingView, and just keep an eye on it. Look at the stocks, whether they bounce off or they're in between the envelope of the 2 stocks or they're riding the line as resistance or support. And hopefully that gives you a little insight as far as what moving average is. And from the simplest form, the SMA, to the EMA, the exponential moving average. My name's Aaron. This is Czar Finance, episode 41 on moving averages. I'll talk to you later. Thanks for watching. Bye-bye.